So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swartz, and welcome to Capital Gains Tax Solutions. Welcome to Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and having a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to grow your wealth. I'm your host, Brett Swartz, and each episode I'm joined by some of the best financial independence and passive income wealth advisors in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. Our next guest is a specialist in cost segregation. Let's face it, many real estate investors, they struggle with reducing capital gains tax and tax savings. So our next guest, again, specializes in cost segregation, and together with his team at Cost Segregation Services, Inc., they help property and business owners save millions of dollars every single year. In fact, over the past 15 years, Cost Segregation Services has completed over 20,000 cost seg studies covering all 50 states and resulting in billions in tax savings. I want you to please welcome my guest, Boomer Philbrick. Hey, Boomer, welcome to the show.
Thanks for having me.
Great. And before we get started, Boomer can be found on LinkedIn as well, costsegregationservices.com. You can call that number and ask for Boomer. He can help you out. So, Boomer, will you give our listeners a little bit about your story and your current focus?
Yeah, no, I appreciate you having me. So my background before I got into doing cost segregation, which I've been in now for about 5 or 6 years, actually worked in college football in the NFL. So I enjoyed helping kids and families in that aspect, and kind of easily transitioned into this to helping building owners and investors maximize their opportunities, kind of open new doors and avenues for them.
Tell us more about that. What team did you work for, and what was your role there?
I worked in scouting and player personnel for the Miami Dolphins under Nick Saban, and then I got into coaching and recruiting at University of Miami and Marshall and a couple other schools before stepping out of that arena.
Wow. So working under a legendary coach like Nick Saban, curious, what did he teach you? What's the one thing he taught you during that time, what you apply today to your business?
I think the main thing about Coach Saban is he's very focus driven. And if it's not going to help us win games on Saturday or Sunday, it's not really that important. So, and he was a very fair coach, that if you stood up for what you believed in, he definitely respected you for it. So I definitely think that the preparation, a strong mindset, good work ethic, being organized has definitely helped transition to cost segregation and what I'm doing now.
Absolutely, because it's so detailed and so crucial to make sure that these studies are done correctly and that owners understand exactly what they're getting into and what they're not getting into. So before we get into the tactical part of it, though, Boomer, I want to understand your success. Sort of, basically you're a wealth advisor for tax at this point is the way what I consider what you do with the cost segregation. But before your success as an educator, who was Boomer growing up? And in other words, I think we're all given superpowers, right? And what was Boomer's superpower growing up, and how does that help shape how you help others today?
I've always been very involved in sports, so definitely developed a strong work ethic, being a good teammate, always kind of pulling up others because a team is only as strong as their weakest link. So definitely a good teammate, team player, and being able to help others. And kind of like you mentioned, especially in the arena of what I'm doing now, it's all about education. And I want to educate you on the opportunities available to you. And if it makes sense for you, great. If it doesn't, at least you know that you've exhausted the opportunities that are out there. Because with the Trump plan and Tax Cuts and Jobs Act, the tax laws are very building owner friendly, but a lot of people simply aren't aware of the opportunities available to them. So it's always education number one, and then we can talk on a case-by-case basis if it makes sense for you going forward.
So Boomer, growing up, I have a similar background, playing basketball and football growing up, and I'm curious if you played, what sports you played. But as a part of being that good team player and learning through that, were those, did your parents say, "Hey, Boomer, you were always a team player. You're always about the team," or was it forged through the fire of, "Hey, this is what a good team player is"? What's your story there with that gift? Was it a natural gift, or do you feel like it was forged through the fire?
I kind of think it's more of something that is assumed in the position, being a quarterback, being a starting pitcher, things like that. That's kind of where you have an assumed leadership role. And then having worked in sports afterwards and seeing how coaches relate to players and how players react to their peers, you definitely find out the best strategies, best tactics to go about it if it's going to achieve the maximum results.
Excellent. So you were the quarterback and starting pitcher. Did you play in college too, any sports, or was it just high school?
I actually played semi-pro baseball out of high school. And then after that, I just got into just college, just as a regular student.
That's great. That's excellent. So what's the most rewarding part about what you do? We're going to dive into the tactical tax savings part, but give me the why behind, being an educator and helping people build wealth through tax savings. What's the most rewarding part about what you do and the service you provide?
I think it's more just helping people realize a huge opportunity that they didn't know was there before. A lot of these savings from cost segregation and from the tangible property regulations, they're game changers for people. And it's simply keeping money in your pocket and allowing you, the smart business owner, the smart investor, to use it for whatever you want to use it for. If you want to buy a new property, if you want to improve a property, if you want to pay down debt, it's totally up to you, but you have extra capital in your pocket to make those decisions. So
give us an example, maybe a recent deal that you worked on. I like to work real live deals. You don't have to give any names, but just kind of give general specs of the deal and how much tax savings it was for that particular individual.
So I work a lot in the multifamily sector, and typical savings on a multifamily property is going to be in your 20 to 25% of the purchase price window that you're going to realize in year one. So people who have listened to other podcasts that I've been on, they will hear it. They will reach out to learn more about it. And then what we do is we run a no-cost analysis on their property to see how it directly applies to them. Because each person's situation is different in terms of their tax liability. Are they a real estate professional? How much savings they're going to reap in year one. So I definitely think that a few people that were not aware of cost segregation and the Tax Cuts and Jobs Act, how it applies to them, definitely opened up doors and allowed them to be involved in more deals going forward with the extra capital that they saved or kept in their pocket.
Okay, so let's just say I bought a $4 million deal, and you're saying with the cost segregation or accelerated depreciation is the actual mechanism here, what we're doing. We're taking something that's, let's say, 27 and a half years that you would depreciate on what's called a straight line schedule, and you're reducing it into 1, 2, 5, 7 type of time frame. Walk us through that actual savings. If it's a $4 million deal today, let's just use 25%.
Okay. Yeah. So on that, so basically with the Tax Cuts and Jobs Act, which was released in September of 2017, Trump said that any property that has a class life of less than 20 years, you can reap 100% bonus depreciation on and reap that all in year one. So looking at a property, we're going to be able to place things like your flooring, your molding, your kitchen cabinets and countertops, your bathroom, any kind of specialty lighting, your window coverings, all things like that can be accelerated and placed into a 5-year bucket. Things like your parking lot, your signs, any fences or walls that you have, your landscaping, all of that goes into a 15-year bucket. So we're going to be able to accelerate and reap all of that depreciation instead of in 27 and a half years, all in the present year. So on your $4 million property, you're going to reap roughly an additional $1 million of depreciation expense in the current year. And then you simply take that times your tax rate. So if you're at a 37% tax rate, there's $370,000 of cash savings in year one. Now, the beauty of Cost Seg is it's not a use it or lose it. So you can use whatever amount of that $1 million of depreciation expense in 2019, and whatever you don't use, you carry forward indefinitely to the subsequent year. So you can use some of it in 2019, some of it in 2020, some of it in 2021, until it's exhausted and used up.
Okay, so let's walk through that. So let's just say I had a property I bought for $4 million and it was producing about, let's say, $175,000 of cash flow. And in this scenario, it's about 25%, so about $1 million in savings. Of that, the 37% rate means $370,000 of upfront savings in year one. So I could use 175 of that 370. So essentially, are you saying that I would have no tax on that cash flow for that given year? Is that correct?
Yes, that's correct. And all of your properties are going to be aggregated together. So whatever savings you have on this $4 million property is not just for that property alone. You can use it to offset income from your other properties as well, because they are all aggregated together. So yes, you'd have an extra $195,000 for 2019, and you can use for other properties, or you can carry it forward and say, you know what, I don't really want to pay taxes very much in 2020. I'm going to go ahead and save that for that. And yes, you can do that as well.
Excellent. So if I had multiple properties and let's say collectively it was $370,000, that was exactly what it was producing. On this one cost seg study, that 370 would wipe out any tax in that given year because the depreciation is offset at all of that income. Is that correct?
That's correct.
Yeah, that's really powerful, right? And now the time value of money kicks in. What can I do with that extra 370? And just for our listeners, the government does these legal tax loopholes because they believe, and studies have shown that it's actually going to incentivize the market to grow. Because, Boomer, now you might take that 370 and, hey, go buy another property or go renovate, right, a property or do something where it's going to spur economic growth, right? Spur jobs, which in turn is going to spur more income tax, which again is the study of macroeconomics. If you can keep money flowing like water, it generally means there's actually a bigger tax revenue coming in. So talk about the legality of this, Boomer. How long has it been around? What does the IRS look at this? Or anything to kind of watch out for when you're doing these types of strategies?
Yeah, that's a very good question. So Cost Seg itself has been around since the early 2000s. Our company has been around since 2001. Kind of like you mentioned earlier, we've done over 22,000 studies in all 50 states. What we use is we use an engineering-based method. So we have engineers place a value on each asset into your property and then place them into their proper and shorter class lives. So out of those 22,000 studies that we've done, we've never had a single line item overturned. So to you, the investor, these studies, as long as it is done by an engineering-based study, it's completely bulletproof to you. Out of those 22,000 studies, we have never once triggered an audit. We've had clients audited for other reasons, and we defend our work 100%. And normally it's a very quick conversation with the person with the IRS. We explain our processes, what we've done, the court cases that we've referenced, and then you're in the clear from there. So yes, it's completely bulletproof if it is an engineering-based method.
Excellent. Yeah, that's a flawless track record, which is so important. You want to make sure whatever tax deferral strategy you're using has a solid track record and then has that defense from the IRS if and when they do come knocking, they have a track record of performance. So, Boomer, I do a cost seg study. I get the tax write-off, but now let's shift to, in the given year, I want to sell my property. does the boogeyman come back and get me here, or what are my options? Walk us through if someone's going to sell in 2 years or 5 years or 10 years, and these reclassifications have happened. Walk me through some of the things to consider in that.
Yeah. So if you're going to flip a property, it's probably not going to make sense to do a study. So if you're going to sell a property within the current year, within the next year that you've just recently bought, the savings from the cost seg is going to be about a wash to the amount of recapture that you're going to have on a property. So we normally say if you're going to hold a property for 3 years or 5 years or 10 years, that's when you're going to reap the benefit. So let's take two different examples here. Let's take that you're going to sell your building outright. So if you hold the building for 5 years, everything that we placed into the 5-year bucket is going to have used up and exhausted its life. So there's not going to be any recapture on that. If you sell the building in 5 years, you're going to have used 1/3 of that 15-year depreciation. So yes, there will be recapture on your parking lot, your landscaping, your signs, your fences and walls, things like that. But then there's something called salvage value. So we don't simply want to be a cost seg vendor, and whenever I give you the final report, we shake hands and go our separate ways. We more want to be a partner within your tax team to help you throughout the life of the property, because there's a lot of additional savings and benefit that you can have after the cost seg study has been done, that you can reap the benefit. So we want to simply be a partner within your tax team to help you take advantage of those opportunities. So going back to this example here, yes, there will be 2/3 recapture on your 15-year property, but then we can help you mitigate that through something called salvage value, or we will help you place a value and help your CPA place a value on those items that still have depreciable basis left that we accelerated, and we can help you to reduce that at time of sale. Now, if you're going to do a 1031 exchange, yes, there's going to be recapture on the property that was moved from real property to personal property. But the beauty of a 1031 exchange is that the property that you're going to be purchasing after the sale of this current property, you simply do a cost seg on that. So, and then it can reduce your amount of recapture from your previous property, as well as offset any kind of income you have from your new property. So that's really the way that people get around it, is if you do a 1031 exchange, it's an easy no-brainer. You just do a cost seg study on your new property. And if you sell the building outright, at the time of sale, we will work with you and your CPA to mitigate your amount of recapture through salvage value.
Excellent. So you're piling cost seg on top of cost seg on every deal you're doing, and collectively always deferring or delaying this recapture tax. And as long as you're holding long enough periods and buying big enough properties, you should be, if I'm hearing you correctly, be able to mitigate much of the tax, or at least get a big portion of it up front. Yes?
Yes, that's correct.
Excellent. So fast forward 10, 15, 20 years, you've been doing this. Imagine you've owned properties, multiple cost segs, multiple 1031 exchanges. What is the ultimate exit from this? What have some of your clients done to, or are they just not selling? What walk us through how this works, or maybe even touch on the stepped up basis if that's a part of it here.
Yeah, so basically you have some clients that are simply buy and hold, that they don't want to sell. They're going to kind of run it within their family or with their partners, and then they're the easiest ones to deal with. The clients who have just kind of gotten into the arena, that'll buy a smaller property, and then they decide, you know what, I'm ready to go bigger. I'm going to join a different deal. Those are the ones that you kind of roll one property into the next property. Like you said, by doing a cost seg on each property to mitigate and eliminate any kind of tax liability that you would have. Because like you said, cost seg is all about the time value of money, and it's giving you more capital right now, and you, the smart investor, to make those decisions rather than giving it to the IRS over a straight line period.
Excellent. Okay, but what does happen, just to clarify, at the end of the, I'm going to exit out of all my real estate, or I'm going to I want to pass it to my kids. Will that stepped up basis eliminate all of this depreciation recapture, or what happens there? Who's going to pay that tax, if ever?
Yeah, so I mean, after it has been exhausted, I mean, if you hold the property for a long period of time, all of the depreciable basis is going to be exhausted. So then you're not going to have recapture on that. And yes, if someone passes away and it's passed it down, yes, there will be a step up in basis. But like I said, we will continue to work with you throughout the life of the property to eliminate and reduce any kind of tax liability that you might have. So this is what we do. We are calculation experts, but then we also have a lot of tax specialists in-house to be able to help you take advantage of all the opportunities available. And the Tax Cuts and Jobs Act is currently in effect in full force with 100% bonus depreciation through 2022. Then in 2023, it goes to 80%. 2024, it goes to 50%. So we'll kind of see here with this new election coming up what changes might occur. But yes, the Tax Cuts and Jobs Act is very, very beneficial to building owners and investors that they can take advantage of about 100% through 2022, and then we'll see going forward.
Excellent. And as a plug for the Deferred Sales Trust, a part of what we can do is, imagine you had a zero depreciation and nothing else left there. You can now sell, move it into the Deferred Sales Trust, and then partner with your trust and go get a brand new depreciation schedule. So let's imagine you had a $20 million deal and you're fully depreciated and you want to get a new depreciation schedule. In a 1031, the depreciation schedule is going to travel, which is not good. But with the Deferred Sales Trust, you can now move all the funds into the trust, and then it's tax deferred at that point, and then partner with the trust, go buy that same $20 million deal and get a full brand new depreciation schedule, of which you could perform the cost seg and do it all over again. So that is a plug for the Deferred Sales Trust. As a reminder, you can learn more about Boomer and his service here at costsegregationservices.com. So Boomer, shifting a little bit now, I consider you a wealth advisor, okay? And you're out educating not only business owners and real estate owners, but also other business professionals. So what's the one thing that you want to make sure that they understand about your services and how you can help them grow their business by using Cost Seg?
Yeah, it's really all about education. So people simply just don't know about it. People will go, oh, if this is such a great tax strategy, why did I not hear it from my CPA? And it's your CPA is hired to file your taxes, to keep you in compliance, to keep you out of audit, but it's not their job to go out and find additional tax savings opportunities for you. So that's why the smart investor who is constantly educating themselves by listening to podcasts, reading books, going to conferences and seminars, as well as people who have friends or colleagues who have done the work and have experienced the benefit before, that's really how people hear about it and take advantage of it. Because if you don't use one of the big four accounting firms, chances are they don't have engineers in-house to do the studies for them. So it has to be outsourced to a company like Cost Segregation or an engineering-based firm.
Yeah, I liken that to the analogy of we deal with the same thing on our end when we're educating people about what we do for the first time. And part of it is, it's like you go to your general practitioner, your doctor, right? And your doctor's helped you for years, and they've done general blood work, and they've done the flu shots, and they've done general work for your situation, for your health, right? But all of a sudden, you might need knee surgery or God forbid brain surgery, right? And now there's a serious a specialist who focuses in that one area, and your general practitioner may not know everything about brain surgery or knee surgery, but they know enough that there's some tax liability, some tax hit, and you can't necessarily count on one to know the other because they haven't been practicing it. So it is of utmost importance to make sure you're working with a specialist who has a proven track record based upon tax law and surviving those IRS audits and case law, all of those things. Because just because they don't know doesn't mean it doesn't work. So, and by the way, it can make all the difference for your tax situation. So, shifting a little bit more here too, what are some of the the best questions to ask potential clients or partners that you're working with? What are the top 3 things to really find out if this is going to work for you?
So the number one thing is that Cost Seg simply offsets income. So if your property is not making money, if you don't have a tax liability, chances are it's not going to make sense for you now. And Cost Seg works on both new and existing properties. So just because you're not making money here in 2019, it doesn't mean that there might be a big change and in 2020 or 2021, you become extremely profitable. So yes, you can do it on existing properties as well. There's something called a Form 3115. It's basically a change in accounting form. It tells the IRS, I was doing straight method. Now I'm changing and doing accelerated depreciation. So that's the thing that we will complete for you, give to your CPA to file. So that's number one. You have to be making money. Now, if you're a real estate professional, this will offset any kind of income that you have. If you are a high earning W-2 wage earner, then it's only going to offset your passive income. So it's not going to offset your W-2 income. It's only going to offset your passive income. So that's another thing to look at as well. And
now, Boomer, what if my wife was a real estate professional and I'm a high-end W-2 earner? Let's imagine I had $500,000 of accelerated depreciation. Let's say my property's making $250, and then I'm making another $150 as a W-2 person, and my wife's a real estate professional. Would I be able to offset that W-2 income there?
Yes, you're exactly right. If your spouse qualifies as a real estate professional, it's all going to flow down to your personal return. And yes, this will offset your W-2 income as well with your spouse being a real estate professional.
So walk us through real estate professional so we make sure that's crystal clear. How do you qualify as a real estate professional, and how might one's spouse who is not a real estate professional become one?
Yes. So there are 11 different real trades or businesses to qualify as a real estate professional. And what they say is you need to spend a minimum of 750 hours a year in one of those 11 real trades or businesses. And it basically equates to roughly 15 hours a week. But if you are a W-2 earner and you have a job that's 40 hours a week, the IRS is going to know that, okay, I spend 40 hours a week on that job. I spend 15 hours a week to equal my 750. This is very low-hanging fruit with the IRS, the real estate professional designation, and it's something that they will check. So if, for example, your spouse, your wife is going to qualify, she simply needs to document what she has done throughout the course of the year to reach those things. So it can be the kind of thing where she is talking to tenants. If you manage your own property, she's collecting rent. If she's doing the books, if she's talking to a contractor, her travel time to and from the properties, if you're looking at new properties, all things like that will help her qualify for the 750 hours in the real estate professional designation. It's just people who, when them and their spouse are both W-2 earners and they don't manage their own properties, that's kind of where you're kind of going to struggle to qualify as that. Because like I said, the IRS knows that it's low-hanging fruit and it's something that they track rather closely. So if you are a W-2 earner and you work 40 hours a week, the amount of time that you spend doing your real estate work has to be equal to that, and you have to earn the same amount of money. So that's basically how the real estate professional designation is difficult to attain for a W-2 earner that's working 40 hours a week. But yes, the example that you gave with, can my wife qualify? The answer is absolutely. And that's how a lot of people will get around it to be able to qualify, because being a real estate professional is really a game changer, being able to offset all of your family's income.
Yeah, that's amazing. And I think there's almost nothing that I'm aware of that can do that. And that's really unique to this cost seg and accelerated depreciation. So just to clarify a couple points there for the designation of real estate professional. So if I'm a W-2 owner earner, then it's not likely that I'm going to qualify in the sense that I need to at least double my 40 hours to 80 and do all of that with real estate. So that's going to be tough to A, do that practically, but B, the IRS, the low hanging fruits would be very careful there. But the second one would be, let's say my wife wasn't making any income. She's a stay-at-home mom, but she wants to help with some of the real estate management, and she already is maybe helping with the real estate management, and whether that be collecting rents, whether that be doing the books, whether that be looking for new deals, lining up contractors, any of the, management on average of about 15 hours per week, then yes, she can qualify as a real estate professional, which then in turn collectively our total income tax return, we can offset all of that W-2 income if we have enough. Is that a fair summary there?
Yes, you nailed it exactly.
How many people are implementing this strategy? And I guess the other part would be this, okay, so you need to actually have property to do this. Do you have to be can you be a passive investor and still qualify? Or maybe the answer is kind of in the 15 hours. You probably need to own something yourself, right? On your own name, yourself. Maybe you can have partners, but you're really the general partner. Walk us through practically what that looks like. Can I own a house across the street that's a rental home and say I spend 15 hours a week there? Walk me through the practicality. Do I need to have 3 rental homes or a 10-unit apartment complex? At what point do you think it's, safe to say you're going to be working 15 hours a week on your rental property?
And this is something that, people think of, okay, I need to document. So when the IRS asks, show me your hours, it's literally, you can document it in a journal type deal, on an Excel thing, basically saying, and you got to do it every month, bi-monthly, things like that. You can't just at the end of the year spend 2 hours and say, okay, I'm going to document everything that I did throughout the year, because the IRS will know that. So you have to document throughout the course of the year what you've been doing to be able to do that. And it's not necessarily a number of units or number of properties, but yes, if you are a passive investor, be it in a syndication or anything like that, where there's 20 or 30 or 40 different investors, yes, it's going to be hard for you to reach that 750-hour threshold by doing it. So it's more of you being hands-on, having direct contact with the properties and things like that. And yes, if you own several properties, you don't necessarily have to manage the properties yourself, but your contact with the contractors, with the management company, all things like that can help go towards those 750 hours.
Great answer, and thank you for breaking that down for us. So we're coming to an end here. We're going to finish with this last questions, but as a reminder, you can find Boomer at costsegregationservices.com, and that's Boomer Philbrick. Boomer, how do you stay centered in your values? This is more of a personal question, right? And keep from being discouraged, or in other words, how do you stay encouraged to keep driving on? You're successful in what you do. You're helping a lot of people, and so how do you personally share with our listeners, stay centered in your values and keep encouraged to drive on?
Yeah, I think that's a great question. It's more so about, I consider every line of work that I've been in, it's all about relationships, and it's a relationship business. And I always want to do the right thing, to treat everyone how I would want to be treated if the roles were reversed. And I think that's kind of how you develop relationships, you develop trust, because let's be honest, nobody's going to do a deal if they don't trust you. So you first have to establish that trust, and then basically show them through your organization, following through with what you said you were going to do, coming through with the results that you talked about or promised to them. That's basically how I found out to be successful in basically any business that you choose to be in. So it's simply not getting off course, not making these false promises or pretenses or anything like that. It's just staying true to who you are. And I always try to put myself in the other person's shoes with, do I want someone calling me constantly? Do I want someone reaching out all the time, or can it only be at times that there's need? So I'm not going to simply I get your contact information. I'm not going to be a pest and continue to stay on you. I always try to put myself in your shoes and say, how would I want the situation to be handled? How would I want to be treated if we were on the other sides of the table? So I think that's basically how I run my business and how I've proven to be successful and have other people trust me.
That's awesome. Yeah, practicing the golden rule and being a value-add resource who's there when you need them, and not over contacting for sure, and pressuring people. I think it's a great reminder for all of us. So I want to thank you, Boomer, again for being on our show. Any last thoughts on Cost Seg and/or where to reach you? Just remind the listeners maybe it's a phone number, maybe it's just the website or LinkedIn. Where can they find you?
So basically, I'm very low pressure. What I would like to do is, if you own a property that you think Cost Seg might benefit to you for, please reach out. What I will do is I will learn a little bit more about the property. When you bought the property, what was the purchase price? Have you done any renovations or improvements to it? And what's the address? So with those 4 questions answered, our engineers can take a look at the property. It's a no-cost analysis. And then after I get that back from the engineers, then we can set up a time to spend 5 or 10 minutes to go over it and review it, review your individual situation, what kind of tax liability you have, do you qualify as a real estate professional, all things like that. So you can reach me. My cell is 812-639-0656. Or like you said, I'm on LinkedIn, or you can reach me on Instagram. It's @CostSeg. Or on Facebook, it's Cost Segregation Boomer. So feel free to reach out in any of those avenues, and happy to simply talk, educate you on the opportunities available to you. And then if it makes sense going forward, great. If not, at least you, the educated investor, know that you've exhausted the opportunities right now. But as your situation changes and as your portfolio grows, it might make sense to you down the road, but at least you can find that out now.
Well, Boomer, I want to thank you for dropping capital gains tax solutions bombs of value that are just incredible with what you can do if you know about cost segregation, accelerated depreciation, and you're working with a group who has a proven track record such as Boomer and his team. So, and I want to thank our listeners again for listening to another episode of Capital Gains Tax Solutions Podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax referral options. Hopefully you've just heard from Boomer how you can really improve your situation through cost segregation and perhaps become a real estate professional. I mean, what a great goal for 2020. Maybe your spouse can become a real estate professional and you can offset some of that W-2 income, or just offset additional income from different properties using cost segregation. As always, not having a clear plan is the enemy, and using a proven tax deferral strategy is the best way to grow your wealth. Until the next episode, go make it a great day.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swartz. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.